Good evening, traders, and welcome to our live webinar today. I'll be taking you through a discussion of the charts today about how to maintain a clear mindset in trading. All trading is not about, or trading is not all about the charts only. You need to take care of your mental state for you to trade properly in the market. So how do you maintain a clear mindset in trading? Because that is very important. That's going to affect the decisions which you make in the markets. So one of the things that you want to consider is having a plan. If you do not have a plan, then you for sure are going to be gambling in the markets. Gambling is where you're doing like you don't know nothing about that thing. You just um, trying to speculate on directions which you cannot follow a specific pattern in the market. So have a plan, and your plan is going to be based around analysis and the entry strategy and risk management. Analysis will help you to understand how the prices are moving. How is the market moving? It's after you understand how the market is moving, that's when you're able to pull up as a suitable strategy. Then you need to have an entry strategy. What is going to inform you where to place a trade, maybe to buy or to sell. And then the other thing is risk management, because there's nothing which is assured. There are no guarantees in trading. So risk management is how are you going to control the risk. So these are the three things which you need for you to have a very clear mindset in the market. Okay. So if you don't know what is happening in the market, you look at the charts and you can't make sense of the candlesticks and the patterns, then you're lost from the word go. You always be worried what is happening, and you have your money there. Another thing is you know where to how to analyze the market. The price is moving up or it's moving down, but then you don't know where to enter. This one calls for you to have a strategy. The strategy gives you specific rules that you will see for you to enter a trade, maybe to sell or buy. And once you do that, then you wait for the market to do its thing, but then you have your controls. Now, if you don't have a plan, or the things that ruin someone's plan are aspects like greed. So when you're joining trading, what are your expectations? Maybe you're expecting to make a lot of money so fast, or because when we look at the charts, of course, you see that this is a move that can give me $10 or $50 or $1,000. So then what happens is you're going to run after that move. For example, you're going to run after entering a trade. Okay, maybe you see the price is bearish. You're going to run to enter a trade, maybe sell, okay, or buy, because you know if it goes down, you will make money. If it goes up, you will make money if you have a buy. But then you have not followed a clear plan. So that is where greed comes in. And for example, you've entered a trade, you need to know the possible areas that it's likely to move to, have targets. So this is one of the things that makes someone to abandon their price. Okay. Lock in profits. When you get profits, get the profits, lock them in, wait for the next trade. Other thing that can ruin your strategy is fear. Why would you fear when you're in the markets? It goes back to the plan. Do you understand the markets? So you understand by analysis. Do you have a strategy? Do you have risk management? If you take too much risk, then of course, you're going to have fear. The price is moving, and maybe you are making very huge losses because you entered a very big position, and maybe you never knew where to enter the trade. So it goes back to make sure you have a plan, analysis, entry strategy, and risk management. So you need to avoid that. And similarity in the market does not actually mean success. So this is where we say market is fractal. Like what happens on 1 minute can happen on 5 minutes. What happened yesterday can happen today, but it is not a probability. Okay. So we usually trade on repetitive patterns most of the times, but remember, you have to wait for the price to lead the way first, and then you enter the trade. But because that one does not mean that the trade is going to be successful. You want to protect yourself. So this here risk management comes in. Another thing is excitement. This one will go back to where you're joining the market. You don't know how to analyze. You are excited because you think you can make money, and you will tell yourself that, or what you see is, and what you know, and it's a fact that if you place a trade and price moves up, if it's a buy, you make a profit. If it's a downward move and you do a sell, you make a profit. But then you're trading out of the excitement without basing your entry with facts. Your entry should be based on analysis with an entry strategy which you have tested over time. But let me pick this one again, another view where you have traded, you've placed a trade, and you've got some profits. And let me link this one again with this part of representative bias. So you placed a trade, you've got some profits, that is okay. And then you forget that you need to go back again to your analysis and strategy to qualify another trade. So the representative bias gets in, and then out of that excitement, you enter another trade. Try this after a trade has given you profits. That is already okay. Take a breather, take some minutes or some time off the charts, wait for another setup. Okay, wait for another setup, enter a trade, but not have one trade exactly after the other one. You are likely to miss something. These are practices you might want to try to avoid losses. And I want you to think through or observe your trading, because most of us have been trading. I expect that. Have you seen that after having several winning trades, like five, six trades, you made some profits, then the seventh one, or maybe 2, 3 trades, the fourth one overturns everything, and that's what becomes a nightmare. Why? Because of euphoria. Probably you were extremely excited. There is some mistake you did. There are things which you overlooked. And that's why it's happening that way. So once you make a trade, it's given you some good results. Take some time off the charts, revisit again after some time, so you can get some clear ideas. And another thing is when you end up losing a trade, how do you want to look at it? Do you now don't project don't project yourself on the wrong side. If, for example, your trade has gone to a loss, okay, look at what have I done wrong. But you have that chance of looking at what you've done wrong if you've not been ruined completely. People who are ruined completely, like you lose all your capital and everything, you're likely to fall into a negativity bias. That's why you start looking at the broker is taking my money, other things which are not good, and then that one blocks you from learning what actually went wrong. So always have the aspect of once the trade goes to loss, that is okay. Here we are traders, we manage risk, okay, and we know we can either get a profit or a loss. So then we go back to risk management. How much loss are you getting? How much profit? So that if the trade outcome is not positive, okay, then you have a chance. You have the peace of asking yourself, why have I gotten a loss in this one? Why has it hit the stop loss? Is it because the stop loss has done its job, like it has protected me, or I didn't see something? So avoid a negativity bias. Have the form the habit of always evaluating your trade if it's a losing or winning trade. And I want to connect this one to the euphoria part of it. If you win or lose a trade, take some time to evaluate it. As you're evaluating your trade, looking at the setup, how it was, then you are avoiding excitement, entering another trade with excitement. So these things are interlocked, or interlinked. Another thing is revenge trading. This one goes back again to negativity bias. So you've entered a trade, you've lost that trade, okay? So you need to take some time and evaluate, why have I lost, right? Why have you lost this trade? Maybe the market, you didn't see the behavior of the market and you are completely off, because sometimes we are like that, even in trading. So you want to wait for another setup, but revenge trading is where you immediately develop a strong desire to recover that money, and that one leads you to entering trades with euphoria. So all these things are linked. I just want to pinpoint them to you so you know. And I want you to think through it and know where exactly you make mistakes and how we can correct. So revenge trading is, if you've made a loss, breathe in, get off the charts for some time, go back and check, where did I go? Where did I go wrong? What could I have done best? Or maybe you never even done anything wrong. It's just the markets that have moved with a different maybe dimension, right? And you accept it. So then you wait for your strategy again to allow you to enter another trade. Another thing, always update your trading strategies. Just because you know about support and resistance and trends, and of course the price will obey those areas. Learn something new. Okay, learn about the newest trending approaches that people are looking at in the market nowadays. There are things like you can observe institutional footprints. For example, when you see big candles and when you see wicks, some big candles will show you gaps there, things like order blocks. Make a point of learning those things, even if you're using trends, right? And even if you're using also order blocks, make a point of learning even these other retail, what we call retail approaches. Okay, I don't know if that's the case, but learn across several things. Make sure that you are changing with the environment. You keep updated on what's happening. Okay, do not stick to something so much. Don't get fixed on one trading strategy, right? Make sure you understand quite a lot and keep making your strategy better. Okay. Loss aversion. So this is where you want to keep on holding, holding on losses, right? You stick to a trade which is going to lose. You stick to it so much, waiting for it to go back, instead of having a stop loss which is going to take it out, right? Always have a stop loss. Leave it to do its work. Don't extend it. Leave it to do its work. That is going to help you. Because what if the loss doesn't pull back? Okay. And then the same challenge is where when you get a very small profit, you take it. But when the loss is there, you leave it to run for so long. This is loss aversion. These are things you need to avoid. These are tips that you can use to have a clear mindset in the market. Once you've placed a stop loss, let it do its work. And of course, remember we said that a stop loss is an amount which you are losing, an amount which you are prepared, which you already know how it's going to affect your capital. Towards the end, we'll look at all those things. Fear of missing out. This is more like euphoria. Okay, more like euphoria. So you've not opened a trade, maybe the move that you were expecting has already occurred and you're not around, but then you want to be in that trade. You go following opening a trade, even though it has passed beyond the levels where you needed to enter. That is a fear of missing out. If you're not prepared to trade that time, do not open a trade. Okay, that is going to lead you to something very stressful. Okay, so you enter a trade, then it goes off the plan because it's not part of your plan, right? Another thing you want to do is risk management. I cannot underscore this much more than this, right? Than I have already done. So you want to protect your capital from being eroded, okay? You want to protect your capital from a heavy drawdown, okay? So in this case, always make sure you have a risk management. If it's a stop loss, that's okay. If you're using a small lot size, that is okay. But do something that you know is going to protect you from making very big losses. That is always very advisable. Risk management is what will keep you in the market for long. Even if you're making very big profits, there might be one day where you might make a very big loss, which may be destructive to a very good trading journey which you've had. So risk management is important. We look at those tips and always make sure you have a stop loss, okay, and a take profit. Always make sure you have a stop loss. Stop loss is important. The market does not, if the price was to move downward, remember the stop loss will be respected. There's a reason why stop losses are where they are. Okay. If a stop loss is taken out, it has helped you from losing a lot of money. If a stop loss is taken out and the price moves in the direction which you were expecting, then you know that maybe you didn't enter your trade at the right place. So you need to reevaluate how you place your trades. So have a stop loss and have a target, put your profits here. Another important tip is invest what you can afford to lose. What this one means is when you're placing a trade, have a stop loss at the point where that amount of money which you're going to lose is something that you are okay with. And when you say you are okay with, it needs to be based on a percentage calculation of your capital. If it is $100, you have 2%, right? If it is 50,000, think of the percentage which is suitable that you don't think is very big. But again, we want to base it on a percentage so that you do not you actually apply a reasonable risk. Remember, if you lose something big, it take you a lot of effort to recover. If you lose something small, it doesn't take much effort to recover. Risk tolerance. So risk tolerance usually is where you're able to withstand losses. But this one you need to look at it in different ways and very carefully. You cannot say that for me, even losing 100,000 is okay. Okay, even losing 50,000 is okay. And that's why I've mentioned that on risk management, always what you can afford to lose should be a percentage of your capital. So as you're looking at your risk tolerance, you should not go all the way to the end of this, what is this? This indicator here that we have. Just tolerate a small loss, not a very big loss. Tolerate a small loss. So risk tolerance, this is something you need to approach carefully. Keep your risk tolerance at a very low percentage. Okay. And this one, sometimes you can look at it in terms of, oh, I'm young, so I can risk as much as possible because I'm seeking a very big growth. Like you want to, the people who trade with full margin. So you've got $100 and you're placing a lot size which is equal to that $100 because you want, you have got a lot of time, you're young, you want to multiply that money very fast. Yeah, by the time you're 1 year in trading, you've made it already. That one might not work that way. You might keep on losing that money up until you're 3 years in trading and you're still losing because you do mistakes. Investment goals, risk appetite, experience, knowledge in investing. So all these determine the level of tolerance that people have. And for instance, where you have very ambitious goals in your trading, and you want to be making like 50,000 every single day, 100,000 every single day. Remember that this market is risky. That percentage which you're looking for should be based on reasonable risk management. Okay, so your goals should go in line with the capital which you have, should go in line with your risk management and also your strategy. Knowledge in investing. When you think you have got a lot of skills and you're experienced in the market, so you have overconfidence. Okay, that overconfidence is going to throw you to a big challenge, or throws traders to a big challenge where you take big risks, you don't even want to play stop losses and all that. Okay, knowledge in investing and experience, one thing. Risk appetite, always have a modest risk appetite. Okay, very high risk is not good. It's like it usually ruins big capital. Okay, so that's that. I hope you can reflect on all this. The other thing I'm looking at is risk reward. Target a modest reward. As you're risking something small, target a modest reward. Okay, like if you're risking, for example, $2 or $10, make sure that the reward is likely to be multiples of that. Okay, this one goes back to the bias where someone tolerates losses, but they don't hold on for profits to accumulate. Risk per trade. Don't take a very big risk in every single trade. One trade is not the end of trading. Okay, if you lose one trade, if you lose 2%, that's not the end of trading. Tomorrow you can get another setup and enter a trade and it becomes successful. So if you risk a very big capital of one trade, then you're risking getting out of the market just because of one trade. So you want to have a 2% risk, for example, so that by the time you ruin 100% or you have 100% of your capital gone, or let's say even 20% of your capital gone, that one means like you've lost 10 trades continuously. Yeah. If you lose 10 trades continuously, then there's something wrong. Okay. And you want to go back to the drawing board. So if it was 2%, then you've lost only like 20% and you've got 80% remaining waiting for you to go and improve your strategy and go back. Okay. So keep a consistent risk. If you're doing 2%, keep doing 2%. Remember the risk reward. You're risking 2%, then target something bigger. And that's how you're going to sustain your trade. Trend. People, this is a saying which has been there for quite some time. It's always be true that the trend is your friend. Follow the trend. Do not fight the trend. Right? If you have a strategy which works against the trend, then you know you are walking against the wave of the market, and usually it's dangerous. Okay, track your overall exposure. This is where goes back to risk management. Right, know the instruments which you trade. Okay, if you're used to trading gold, then when it comes to trading indices like Nasdaq, it's a different story. So have the practice of testing anything you want to trade live. Test it first before you trade something live. Test it first. Do not try with your live money. Test it first on the demo and see how it behaves, because different instruments have got a different behavior in terms of how the prices moves. Yeah, how does it spike so much? Does it have very high volatility? Does it does it have a very big peep value? Because all those add to the risk, okay, and the reward which you're looking for. Okay. Also understand which instruments are linked. Once you understand the instruments which are linked, then you can avoid exposing yourself without knowing. For example, like you're trading on Canadian dollar, you're trading on oil, that is something related, okay? And they might be affected all across. Something affecting Canadian dollar can affect the oil, okay? If, for example, it is gold is traded in terms of USD. Anything affecting USD is affecting the gold as well, gold prices, right? So you need to link them so that you don't find yourself trading two things maybe in an opposite direction and they are negatively correlated. So you end up getting double losses. So these are the tips that you need to follow a little bit, but most importantly, I go back here. Make sure you have a plan. We always have these trainings in our centers. Attend those trainings, and we've covered them even in our YouTube channels. Learn how to analyze the market. Learn a strategy which you can use. Learn risk management. And these ones don't have to be very complicated. Just keep them simple. You might be surprised how a simple trend following strategy can make you money if you've taken time to understand it. All right. And that's going to give you a clear mindset when you're trading. Okay. Whenever you know how to read the behavior of the market, how to enter your trades, and then how to control the risk, then you are able to at least breathe as you're trading. You get me? At least breathe as you're trading. Because sometimes you have trades and they're going terribly wrong and they're almost giving someone blood pressure, those type of things. You don't want that type of trading. Okay, so all those things I've talked about, they're very important. Go through them. It's quite a lot for someone to get it all at once. Go through them, practice them so that they get into your system, right? And you practice them just like what we call it, just like yeah, it's something which you're used to doing. It becomes almost natural for you. I don't know whether I have any questions. I have Jackson. Hey, Jackson, I see you waving at me. Hey, William. Hey, Paul. Thank you for your salutations. It's been great speaking to you. If you don't have any questions, then we can call this on our session, and let's see each other next time. Use those tips in your trading to get better. Thank you. Good evening. Bye.